Welcome. Today we're going to play detective and solve a bit of a corporate mystery. We're going to look at how a really common, simple accounting choice can create this powerful illusion, one that completely hides what's really going on inside a company.
So let me start with a question, one that might make you a little uncomfortable if you run a business. Is it possible that your star product, the one you think is making you all the money, is actually a financial black hole in disguise? Well, we're going to find out.
To get to the bottom of this, we're going to investigate a company I'll call Skylar Incorporated. They're at the very center of our story, and, on the surface, everything looks fantastic. But as we're about to see, the numbers don't always tell the whole truth. So, Skylar makes these office workstations. They've got their bread and butter product, the basic workstation. They sell a ton of these, like 10,000 a year. And then they've got their fancy high-end model, the premium workstation. It's way more complex, they sell a lot fewer of them, but hey, it comes with a much bigger price tag. Now, using their standard accounting systems, Skylar's management looks at this and sees a really clear winner. The basic workstation, yeah, it makes a pretty decent profit. But that premium workstation, it looks like an absolute superstar, pulling in more than double the profit for every single unit.
That's the number everyone's looking at. $242.86 in pure profit for every premium workstation sold. So, based on this, the strategy seems obvious, right? Push the premium product, invest more in it, and just watch the cash roll in. But what if that number is built on a complete fantasy?
And that right there brings us to the flaw in the whole system. The problem isn't the direct costs, the materials, the labor, that stuff's easy to track. The real problem is the overhead, all those other factory costs, and the super simplistic way they're just spreading them across all the products. You see, Skylar, like a ton of companies, uses what's called traditional costing. They basically take their entire bucket of overhead costs, we're talking over $1 million, and just spread it like peanut butter over everything using one simple little metric. In their case, it's how many hours of labor each product takes. The best way to think about this is to imagine you're out to dinner with a friend. You order a simple salad. Your friend, though, they order the giant, expensive lobster platter. With traditional costing, at the end of the night, you just split the bill 50-50. So you end up paying for a huge chunk of a lobster you never even touched, while your friend gets an amazing deal. That's exactly what might be happening at Skylar.
Okay, so if just splitting the bill is unfair and frankly wrong, what's the alternative? We need a better way to do this. We need a way to see who really ordered the lobster. And luckily, there's a much more precise tool for our investigation. It's called activity-based costing, or ABC for short. And instead of one giant bucket of costs, ABC looks at the specific activities that actually cause costs. Things like setting up a machine, doing a quality control check, or packing a shipment. Then it carefully traces those costs only to the products that actually use those activities. So, going back to our dinner, with ABC, we're not splitting the bill anymore. We're itemizing it. Now we can see exactly what each person, or in this case, each product, actually consumed. We're about to find out the true cost of that salad and that lobster.
All right, time to put on our detective hats. We're going to apply this activity-based costing to Skylar Inc., and we are going to follow the money. We're going to find out where that $1.1 million in overhead really goes.
First things first, we break down that giant overhead number into what accountants call activity cost pools. But really, it's just the real work that's happening. We see there's $300,000 for setups and quality checks, $500,000 for machining, and so on. Right away, this gives us a way clearer picture than just one big meaningless number.
So how does it work?
It's pretty straightforward, really. Step 1, we figure out the price of each item on the menu. The cost per machine setup, the cost per shipment. Then step 2, we just count how many of those things each product ordered and send them the bill. Simple as that.
And here we go. These are the results of our investigation. The moment we start tracing the actual activities, a completely new story starts to emerge. Just look at the premium workstation. Even though they don't make that many of them, it's consuming a huge share of the really expensive activities. It needs more complicated setups, more machine time for each unit, more special handling. The costs are just piling up. So, we've followed the trail, we've itemized the bill, and now it's time for the big reveal. It's time to see what happens to Skylar's so-called most profitable product when we finally expose it to the bright light of accurate data.
After all this digging, what is the real story at Skylar? Which product is the hero, and which one has been the villain in disguise all along? Let's look at the numbers side by side.
And there it is, a complete and total reversal. The humble, high-volume basic workstation is actually more profitable than they ever thought. But the premium workstation, oh boy, its profit has been absolutely demolished, dropping from $242 all the way down to just $152. The star product was a total illusion.
I mean, this chart just makes it painfully clear. That huge drop, that represents the lobster that the premium workstation was eating all this time, while the basic salad product was footing the bill. The profit wasn't real. It was basically a subsidy, hidden by a flawed, lazy accounting system.
At the end of the day, here's the bottom line. The simple averaging method was punishing the simple product and rewarding the complex one. It was totally blind to the fact that the premium workstation was a resource hog, consuming way more of the company's resources than anyone ever realized.
So what does a company even do with this kind of shocking new information? I mean, this isn't just about getting the numbers right for the sake of it. This is about using those correct numbers to make dramatically better decisions for the entire future of the business.
And the implications are huge. First off, pricing. Clearly, the premium product is underpriced for all the resources it's soaking up. Second, now they can manage the resources way better, targeting cost-cutting efforts on the specific activities, like those complex setups, that are driving the premium product's costs through the roof. And maybe most importantly, they can finally build a real strategy based on which products are truly making them money. And that is the absolute key takeaway here. This whole thing isn't just an exercise for accountants to be picky. It is about giving managers a clear, accurate map of their own business so they can actually navigate. Without it, you are flying completely blind, making huge decisions based on a profit illusion.
So we'll end on this thought. Skylar Inc. just discovered a fundamental truth about their business that was hiding in plain sight the whole time. It really makes you wonder, doesn't it? What illusions, what hidden truths might be waiting inside your own numbers, just ready to change everything? Thanks for watching.